Hey Ian, thanks for hopping on. I see Rashad, Jason, Funny joining us as well.
Hey guys, good evening. Funny here.
Hey Funny, thank you for joining.
Yeah, nowadays. Thanks for scheduling this, man. Really, all the previous sessions were really great. So I'm hoping to learn from this as well.
We're glad to hear that, Funny. It's a team effort.
Hey JD, hey Alex, how are you guys doing?
Hey guys, what's up, Hashard?
Hey, Jason.
Good.
Hey,
Hey,
Julie.
Rashad. How you doing?
Great. Cleaning up after my dog again.
All right. Yeah. Good. Is it getting cold, Alex, up by you?
This morning I went to walk outside for a 25-degree walk up here. I had a balaclava, I had a beanie on, I had gloves. I am telling you.
And you're all set and happy about that.
I was good. I was
Yeah.
on my 1 hour walk, hopped on the 2 Zoom calls during that time. I said, yeah, I'm good.
That's good.
Yeah.
Yeah.
Alex, is this snowing there already?
There's snow on top of the mountains.
Oh, wow.
So, yeah.
Are you a big skier, Alex?
I do snowboard.
Oh, okay.
Yeah. My daughter just got her season pass, and I last year for this season. We just bought one.
What is it
So
costing now?
right now we got the local one, so it's
Yeah.
like 800 for both of
Okay.
us.
Isn't that amazing?
Oh,
I
for
used to
both
live
of
in
you?
Colorado
Wow.
and go skiing, and I mean they're up in the thousands. It's crazy.
Yeah. If you get like the
Mhm.
the one where you can go everywhere.
Yeah.
We just got the local ones, Heavenly, Kirkwood, and North Star. So,
Okay. So what's the other
yeah.
one on the other side of the lake from Heavenly? Starts with an S.
Sierra Tahoe,
Yeah.
Squaw Valley.
Squaw Valley.
Squaw Valley.
I like
Yeah.
Squaw Valley.
Yeah. Squaw Valley is nice.
Yeah.
Yeah.
Heavenly is a little bit too orchestrated and advertised and yeah.
It's just so close.
Yeah.
It's like 5 minutes away. My wife drops us off at the gondola, and then we're gone. And then I'll shoot her a text. Can you pick us up?
That's awesome. My claim to fame is riding off-road in Tahoe and getting to a bunch of water, and I started splashing everybody, and they said stop it, and I slipped and I cut my hand, and I had to ride to the hospital with my hand up, and people are honking like, get out of my way. I'm like, there's blood rushing down. They're like, get out of the way.
Oh, boy.
I won't be splashing anybody anytime soon.
Right.
Awesome. So I think we're at 5 minutes over. People are still trickling in. I see Suraj and Sip are on. Thanks, guys, for joining. Suraj, good to see you after a long time. Appreciate you hopping on.
Yeah, Jay, I hope you're doing well, man. Just hanging out, not doing a whole lot this Friday evening. So I thought I'd see what's going on with you guys, and hear some market update.
Awesome. Great to have you on. Great. Think Alex, maybe you can kick it off and then we'll pass it over to Julie.
Yeah, well, welcome everyone for the CCG webinar here on this amazing Friday night. We have a very special guest. For those of you who don't know, you will know her now. Julie Anne Peterson is not only a specialist in the lending world, multifamily, she also hosts an amazing show. How many years running, Julianne? And you only missed like 2 days?
Yeah. So 4.5 years we have been doing it, and we've closed 200 million just with the people in the room. So
My
it's
gosh.
awesome. Yeah.
Yeah. Zoom at 8. For those of you who don't know, now you know. So, Julie Anne, I'm going to let you introduce yourself more and let you kick off the call. And for those of you who have questions during, hold off until the end, and we'll do some Q&As after. Julie Anne, thank you.
Thank you so much, Alex, for allowing me to come tonight. I'm excited. I want to make sure that you can see my screen. You guys can see that?
Yeah.
Yep. We
All
can
right,
see that.
awesome. I'm going to move, hopefully, you know what? I need to move it up. Sorry about that. I'm going to move it in my view here so you don't, my head's not tilted. So, all right, there we go. And then I'll make it big. There we go. Perfect. Well, again, thank you so much for inviting me. It is a pleasure
right
to
now,
be
Julie
here.
Anne, I'm seeing the purple Google screen.
Oh, you are? Okay.
Yeah.
Let me stop sharing that. That's not going to be helpful for us tonight. Let me regather that. And that's on my number 1 screen, Alex Tam presentation. Hopefully this comes up. How's that?
Let's see, it's coming on. There it is.
Okay, perfect. All right, great. All right. So Alex, how great is it that I get to be on your show? We met a year ago and just happened to say, hey, do you happen to know my sister-in-law? And here we are. We're in the same industry. We know similar people, and now we know a lot of similar people. So it's really cool to be here with you and your audience. Old Capital coined this survive to 25. And as you know, and many of your listeners have gotten into this potentially recently, and it is a tough market. And we're going to go through a lot of our thoughts, some of the things that we're seeing on a regular basis, and some of the good and some of the bad. But also I want to make sure that I give you some tools. So if you're underwriting these deals, you can have an idea of where things are, where you're going to size them, how you're going to put them in your underwriting model. And we think that we're going to thrive in 26. It doesn't matter. It doesn't rhyme, unfortunately, but we do believe that we are a trajectory at 25. We're going to get reorganized and we're going to see some great things happening in 26. So don't leave too early. Okay, so we're going to talk about our company, Old Capital Lending. I'm going to go over a quick market update, get you guys knowing where we are, and you hear a lot of stuff in the news, and some of it you need to understand, some of it you need to just kind of turn the channel. And we're going to talk about finance options, and then some time to talk questions and answers. So again, my name is Julie Anne Peterson. I'm with Old Capital Lending. We are a premier provider of debt. That means we're going to go out. We're brokers. So we're going to go out. I kind of call it my trench coat of different options. And we're going to find the best financial option for your deal. Okay. I've been doing this for 30 years. I've been doing sales transactions. On the buying side, I owned 20 single family, and then I went to other smaller transactions up into a 20 unit building, and lenders would say, go away, just go away. You need partners. And I said, no, I can do this myself. Just like Edna Mode, who said, no capes, no capes. I wanted to wear the cape because I thought I could do this myself. And so what I've learned in the last 15 years is that you really do, you can't do this yourself. You need partners. So we as a lender are your biggest partner. So you got to start ticking off, who are my partners that I need to start making relationships? And one is your lender, one is your brokers. You don't just have one broker, you have many brokers. You have attorneys, you've got, your investors. So things that you need to be thinking about, especially during these times where it might not be as quick as we've seen it in the past. So Old Capital, we close about $1.2 billion a year. Now this year's not going to be the same. We've closed so far 7,000 loans, being in business for 38 years. So we are real experts in this, especially in multifamily. We also want to create a place where we can help educate and add value to you, because in the long run, this is a commoditized transaction. You know, when you go out to lenders, a lot of people in single family, they'll throw it out to 5 or 6 different brokers. At least I did. And I got my hand spanked. You do not want to do that in multifamily. You want to pick an expert group that you can go transaction to transaction, that have execution certainty, that you know they're going to close. So here's an example of how we add value. So Old Capital Podcast has been around for about 8 years. Not many podcasts have been around that long. So Paul Peebles, who's the owner of Old Capital, and Michael Becker, they get together on a weekly, monthly basis and share with you some very, very good information that we think is critical to your success. So make sure you're putting that in your selection, www.oldcapitalpodcast.com. And yearly, we just finished October 4th and 5th, we had our yearly Old Capital Conference. Again, we're trying to help people understand the market. So this is not, we're going to sell you something. This is real life investors, brokers, property managers, people that are doing business. So come join us next year. It's around September, October. It's nationwide. People come from everywhere. Highly recommend it. This is my Zoom at 8. Again, it's every Tuesday night. We bring in industry experts to share their knowledge with young investors and old investors. You know, we don't discriminate. So you can find your sponsors, investors, partners, attorneys, insurance brokers, all come to Zoom at 8. We have anywhere from 25 to 100 people every Tuesday night. So take a look at that. You can sign in on dancinginvestments.com. Here are the asset classes that you'll find in commercial real estate. Again, we're 93% is in multifamily. So we really are experts in this, but there are other asset classes, and don't shut your ideas off to those others. Because if you look at industrial, it is almost as good as multifamily. It's really great fundamentals. Stay away from office, but look at maybe student housing, retail, storage. We've got great asset classes, and we can help you with that. What I want to do is make sure that you do understand the brokerage world. Okay, brokers, you can go directly to a bank. You can go directly to a DUS lender. A DUS lender is somebody who provides debt from Fannie and Freddie. I'm a broker. I provide debt for Fannie and Freddie. But I can also go to lots and lots of different lenders. So it's really important that you find somebody that you know, like, and trust, right? Somebody who has a track record, that they have execution certainty, that we're educating you, you know, providing value, and that we work on your behalf. You know, if you go direct, and I've seen this recently, where you go with a sales broker. So they also want to get your debt. Well, think about that for a minute. If they have the sale and they have the debt, they may not be working on your behalf. They may be working for the seller, right? So you want somebody who works on your behalf. So just some words of wisdom, don't be bullied, because I've seen this where these investment sales people, they will say, you know, you got to give me and my brokers the deal. In order for us to give you the deal, you have to do business with my lender. So don't be bullied. It's crazy. And again, choose a broker and go with them. You would maybe shop around for the best person that does plastic surgery, but you're certainly not going to go and ask them to give you the best deal, right? You're going to make sure that you're working with someone who's going to deliver the best product at the right time, right? Some of us have been working on these deals for 2 years. You don't want a lender or a broker who can't deliver. So that's all I have to say about that. Here is our quick market update. And this hopefully will play. I don't know if you can hear that. Can you hear that?
We can't right now. We cannot.
Okay. Okay. So he's talking about the foreclosure crisis. And it is real and it is coming. We are just on the tip of the iceberg of foreclosures. And a lot of it is driven by the bridge lending that a lot of people jumped into. And we're going to talk more about that. So kind of looking at what's happening, we have a huge amount of development that has taken place over the last year, 2 years. And if we look at the last quarter, we have delivered over 198,000 units, and we have only absorbed 98,000 of those. So you can imagine there's a lot of concessions going on. There's a lot of occupancy issues. There's, people that are now starting to double up. So occupancy is dropping. So this is certainly affecting a lot of the people that are trying to get into deals because there's more buyers than sellers, and this is really affecting the pricing. That's what we all need to get on the right and same page, because a lot of sellers think and they've told their investors this is the value of the asset, but yet the market is not dictating that. Really difficult to get ourselves around the cap rate environment right now, because there's not a lot of comparison to be doing in a lot of these markets. We're down 88% in unit volume of sales. So it can be challenging, but for the first time since last year, same quarter, we've got positive rent growth. So I'm happy to see that, but unfortunately, year over year, we're down. We really thought it was going to be around 3%, and we are at 2.4% on rent growth. And I would tell you that a lot of us are seeing a 2% or even less on underwriting models to not be, going for 3%. What we are seeing is a lot more business coming to the Midwest. The flyover states has been strong for many, many years, but we forget about it. There's been so much hype about Dallas, right? And Austin and San Antonio and Houston and Atlanta. And as you can see here, the rent growth year over year is not where it was, 2 years ago comparatively, but we are seeing that in the Midwest in 3% or greater in Indianapolis, Kansas City, St. Louis, Cincinnati. We're seeing a lot of opportunities coming from those markets. So if you're not thinking about that, I would start to look at the metrics there. Miami is also still a very strong market. Oops. So some of the things that we have seen on the underwriting of these deals is the expenses. We've seen a huge increase in expenses from taxes, insurance, and payroll. Payroll as in the people that are working for you, for your company. We were seeing in many markets $500 to $900 a door, $900 a door, and now we're up into $11, $12, and as high as $2,500 a door in some of the Florida markets. So this has significantly impacted a lot of deals where we're just not being able to raise the rents. So your revenue is down, your expenses is up. So I know that a lot of you are starting to track that. And I think that's going to be here for a while. As I mentioned, the loan originations are down, obviously. They're the lowest since 2014. This is just an interesting piece, I thought, and it talks about 71% was last month. We just got the update. It's at 88%. Investment sales are down. But if you look here, the non-major markets, so those are going to be your small and tertiary markets, we're starting to see a bulk of the volume and the sales going up in those areas. So again, thinking about how can I be successful today, getting into deals, you might start to look at those smaller tertiary market deals. We see an opportunity. We're also seeing the distressed market. You know, it started with the 3,200 units in Houston. You know, Jay Gavinelli, he really kicked it off for many of us, and we're starting to see this on a regular basis. I've seen auctions. So be really careful about what you're looking at. Be looking, there are opportunities on the assumptions, but when you're thinking about getting into a deal, your second most important question is, where is the equity going to come from? Equity, I heard it last week, I heard it this week. There is a ton of equity on the sidelines. In fact, Marcus and Millichap, John Seabury said, and a lot of people were posting on LinkedIn, oh, there's a bunch of money on the sidelines. Yes, for institutional, for A class. Where are you going to find the money for that 70 unit building, for that 30 unit building, for that 90 unit building? It is challenging right now. And really your second question is, where is it and how am I going to find it? You don't want to have to find investors when you have a deal. You want to have investors before the deal. And this is a great reason why you're here. So a lot of us need to get back to the basics, which it must cash flow. The debt must be permanent. We have to get away from the bridge, which caused a ton of problems, which none of us would have suspected. Believe me, nobody would have anticipated these deals going up as high as they did and the revenues being so low with the decrease in rent growth. The going in cap rate must be above the interest rate. This is a significant issue that brings you into negative leverage, and that's what we don't want. Of course, if you're going for an assumption and you're almost there with your cap rate, then maybe it makes sense. But to be completely off is not a good decision. And you can't think about this as an appreciation play. All right, so where are the markets? How are we determining the interest rates? So there's two metrics. It's two indexes. One is the 10-year Treasury, and one is the SOFR, which is your short-term interest rates. That's the Fed funds. Now there's also Wall Street Journal Prime, and that's really based on a lot of the banks. But a lot of the big deals, we're going to look at the 10-year Treasury. And by the way, we're at the highest it's been. Since 1965, we got up to 5% earlier this week. 5%. That's just for that index. That's only part of your interest rate. Okay, so you got your 10-year Treasury plus a spread. Now, these spreads used to be, low ones, 1.5. Now we're up to 2, 2.5, right? So you take 4.84 and you add 250 and you're at 734. And that's going to be a yield maintenance. If you want to go step down, we're going to add another point and a half. It's crazy, but that's the market. So you have to be looking at these deals with that understanding of, this is where the rates are. We can't go backwards. We have to move forward. These short-term rates, again, this is the Fed funds. They started out very low. Many of us bought in 2021 when we used these bridge loans, this adjustable rate. And for a long time, for almost a year, 2 years, you can see we were at 0.05, 0.50. And then it started to run rampant. Now we're at 5.5. So if you purchased a deal back in 2020 and did not put a rate cap on a deal, which is an insurance policy, and we're going to talk about that, you could potentially be paying 9%. Your monthly mortgage is based on a 9%, 9.5% rate. It's crazy. So how are we looking at this? We're looking at, well, yes, previously we have seen some very high rates, right? And at that time, we were in it, right? So back in 79 to 85, we were at 11.5%. And that lasted for some time. Then we dropped down to 6.8 and then 4.4, and now we're at 2.3. So, you know, I'm sorry, that was when in 21 we were at 2.3. Now we're back up to 4.84. So again, it's as my company is called Dancing Investments. That's what we use, because these are investments and they are not straight lined. They move up and down. So we have to be able to choose the right product for your business plan. So the long term, we're still below. 5.6 is the average. So we're still below. And as you know, and many of you heard, the cap rates were really compressed over the last 3 years. And we're starting to see that change. This is an interesting model here. And this talks about why people have stopped buying, because the 10-year treasury, you can go down and you can purchase a 10-year treasury at 4.84 today, and the cap rate is below that. I mean, in fact, the cap rates in some markets are at 6%. And again, you want to be really careful when you're buying these assets that the interest rate, the product that you're putting on it is, and for the amount of time that you're purchasing it, makes sense. Again, people are just running down and buying T-bills with there's no risk to them. There's no return, a loss of returns. So this is why a lot of people have stopped or are kind of on the sidelines for multifamily. I put this together. I wanted you, and this we can go into deeper on another conversation, but as I mentioned, the cap rates were really compressed for A's, B's, and C's. So you could buy a C and it was, let's say, 4%, and an A was 3.75 or 3.5, depending on when you were looking at it. That is now changing. We're seeing significant differences in cap rates. And it really is showing you that the leverage that you're getting on some of the A class is a lot different than what you're seeing on the C class. So I'm going to just really break this out here. So on an NOI of $1 million, if you look across the top here, the loan amount for that asset at a 4% rate is $13,961,000. But as the interest rates go up, the loan amount goes down, right? There's just lower leverage. And conversely, you can see the cap rates on a 4% cap rate and a NOI of $1 million, you're at a purchase price of $25 million. But as the cap rates expand, that value goes down significantly. Okay, so what this is showing is a lot of these C class assets, these are your value add assets, really only make sense. These are our interest rates at 6.5. We're really at 7.50. This is a little bit dated now. It was just last week that I put it together. You're really losing your leverage, which means you have to bring in more money. And that is an issue. Again, we're talking about the equity, finding the equity. This comparison is really clear about how the interest rates and the cap rates are significantly impacting these deals. So what you do need to start thinking about is shifting your mindset from this fix and flip model that we have seen for the last 3 years to more of a long-term hold. Now, you might be thinking, do I want to go with a 5-year hold, or do I really want to be looking at a 10-year hold, but I can get into a deal right now that is a 5-year hold and refinance into longer term lending. Now, that is, the crystal ball is not working right now because we just don't know where the rates are going to go. In 5 years, potentially. If you look at the forward curve shows that the rates on the, of course, on the federal funds, which is your SOFR, are going to decrease. But what about the 10-year treasury? What do we know? So it's really important that we get a good understanding of what is the capital stack and where is your position as an investor, as a general partner, as a whole, how that lending is going to impact the deal. So a lot of us come in on common equity. So that's the last to be paid out. I'm on the senior debt. So that's going to be I'm going to get paid out first. And some of these deals are getting to the end and they can't find any more money. So we're bringing in pref equity. And those people are, depends on when they come in, but they can really dilute the common equity. So you need to be thinking about how this payout is going to affect your investors. So these are the debt vehicles that we see today that are working. Assumptions and bank, bridge, and agency. So assumptions, we're going to talk about each one of these. We're going to break it down. Here's some examples of what we're seeing. These are deals in the Dallas area, Houston. These are deals that are currently being marketed and they're all assumable. Now you need to be really careful when you're looking at assumptions, because if they're not, have a long run of holding to their maturity date, and you're getting into, let's say, a 3.75% rate, and it's only 2 or 3 years, we don't know where that's going to go. We don't know where you're going to have to refinance in it. So so it's really, you got to be thinking about and stressing that on rates at 7.5. So making sure that there's enough time left. Cost averaging, if it's going to be at 4 years left, cost averaging, if your business plan is 10, making sure that you're looking at how that's going to affect it with the higher interest rate. And by the way, it's not that the seller moves out and you just simply move in. You do have to qualify. You have to have all of the guidelines, which we're going to go over, to qualify. So we help with that. We can help with assumptions. So we're going to go over bank, and bank really has been in the past a starting point for many investors. This is non-recourse lending. This is where we're going to look in your all of your files. We're going to look at your tax returns. We're going to look at all of your bank statements. We're going to get a real good feel for you. We're going to run your credit, and we're going to see if you have some contingent liabilities that are going to affect the way you're going to be able to afford this. And we may even ask for more of a deposit, more of an investment. When we talk about banks, we are looking, a lot of the banks are going to look for a relationship with you. So when you go and you live in Ohio and you want to buy something in Houston, a lot of banks don't want to have that long distance relationship. They want somebody local. So you may have to put somebody on your team that's local, that's going to represent you. Because if there's a fire, you can't be there. You can't get there from Ohio overnight. You can overnight, but not, run over there when the phone rings. So typically, again, banks are all different. They're all run differently, but these are kind of the terms that we find as a whole. So usually it's a 5-year fixed loan. We're running a 1 to 2 year interest only. It's typically between a 20 and 25 year AM. You get 70 to 75% loan to cost. That means that we're going to roll in some rehab dollars, which is awesome. They're going to do your debt service is going to run between 120, 125, and 130. I saw today it was at a lender was at 140. So it just depends on where they're at in their buying cycle. Origination is 1%, so you have to pay the bank. And if I'm involved as a lender, as a broker to the deal, I brought it the opportunity to a bank, I would get a 1% as well. Now, all banks are different. Some have a prepayment penalty, some do not. Some say, hey, after 3 years, you can get out. So bank lending is a great option, especially, if you're new. And we're going to start at $1 million. You can go on your own and find financing below 1 million, but you'd be doing it on your own. And that makes sense because it's costly to have us help you on a less than $1 million. Okay. 2 ways to go with bridge. Again, we're still doing bridge, but we're doing fixed bridge. This is a bridge to stabilization. Now, stabilization could be that we just need a new property manager, or maybe you need a renovation budget. So fixed bridge is great. I call that going to the left, or adjustable is going to the right. So we're going to the left on fixed bridge. These are non-recourse loans. So you're going to sign on the loan and you're going to do your best. If there's a default, they're not going to come after you personally. That's non-recourse versus recourse. But the fixed rate bridge is expensive. It's 10.5 to 11, almost 12%. This is going to give you 2 to 3 years of interest only payments. I mean, I love that. Rent is coming in and you may be paying out distributions depending on your business plan, but you could be using some of that rent money to pay for your expenses, right? But the loan is interest only, and you have the opportunity for another year to extend it and another year to extend it. So in essence, you could have a 4 or 5 year loan and have the same interest rate potential. Okay. These also roll in the rehab like a bank. So you've got 70 to 75% of the purchase price and 75 to 100% of that CapEx budget. So on whole, it could be 75 to 85% loan to cost. Now, the reason why so many people did this bridge product, and that's really on the adjustable, is because when everybody was getting paid, right? We weren't working in COVID and all this money is coming in. Everybody looked at each other and said, hey, let's get into real estate. And everybody pooled their money and they only needed to bring in 15 to 25% of the down payment, right? Well, that's no longer the case. A lot of these on the adjustable rate side, we've got debt yields that we have to come up with. So it's not as attractive. And a lot of people want to get away from that, the bridge product altogether. Our fixed bridge is a 30 year amortization. Interest, again, is minimum interest. That means you have to be into this deal for a minimum of 6 months and as much as 18 months not to get a charge. So let's say, for instance, you want to get out of this loan in 12 months. You would owe us another 6 months of payments to get out of that loan. Okay, so that's one thing. You'd also have an exit fee. We have an entrance fee and we have an exit fee. And then we also have a broker fee. Those are 1% on each of those. But a bridge can get done really quickly, as soon as sometimes as 12 days, but really more like 30. And this product is 500,000. So we can help you on those really easily. Now here's the adjustable bridge. Again, it's a 2 or 3 year loan. We've got that extension of 1 and 1, but this is based on SOFR. SOFR's at 550, plus you have a spread of 450. So we're really at 10%, and it's adjustable. So I'd much rather be on the fixed bridge side than the adjustable. And here's why. Because the adjustable rate, you must have a rate cap, which is an insurance policy. And these are extremely expensive. Let me walk you through that. On a $20 million loan, we're going to, let's say it's a 3-year loan. We're going to give you, it's going to be 2% of a strike. So what that means is we're going to take today's SOFR rate, which is 550, and we're going to put a cap on it of 2%. That means we have to, as the operator, we have to pay for $750 for the mortgage. If the rates go up, let's say they're going to be at, right now they're at 9, right at 10%. The rate cap company would pay that bill. Okay, that rate cap insurance policy for this example is $1,516,000. It's very expensive. Now what's happening is people have been in these deals and they're coming to maturity. Okay, a $20 million deal today for 1 year is $661,000. And many of these deals cannot afford the $661,000. And this is why we're starting to see capital calls. And that's because they have to pay to extend it, 1% typically, and they have to pay to get a rate cap. So many of these deals are calling up their investors and saying, you know, can you give me some more money? If they had only gone to agency financing, where, you know, 2 years ago, we were only doing deals, let's say at 50%, maybe they wouldn't be in this situation. And unfortunately, that was not the trend. The trend was to go into the bank financing. Into the bridge lending. So let's talk about agency, because this is and has been the gold standard in multifamily financing. We do tons of this, but you have to qualify. So what does it take to qualify? There's 4 requirements. So the first one is you have to have an asset that is 90% occupied for 90 days. So you're looking at a T12. You're seeing that, you know, their revenues have been going up. It would be great if also your occupancy was going up and you had a long-term trend of over 90. That would be great, but that doesn't always happen. So when you're talking to your brokers, make sure, hey, I want this kind of lending. So you can have 1 month, let's say you get into this deal in October, 1 month, 90% occupied. So we're going to assume that you're going to have 2 more months, the time it takes to close, 2 more months, that's at 90% occupied. But here's the deal. If it drops below 90% on the Fannie side, you're out. Fannie says, sorry, it needs to remain at 90. But if we go over to the Freddie side, they will say an average of 90%. So you're at 95, it drops below to 85 and it gets back. It's an average of 90% on the Freddie side only. So keep that in mind. Second, net worth greater than the loan amount. So that's cool. How do I get my net worth on a $20 million deal? My net worth has to be, you know, 15 million. Okay. Who has that? Not just one person. You have got to find your partners in the deal who are going to bring that net worth. You're going to combine everybody's net worth. Okay. The third piece is liquidity. It needs to be about 10% of the loan amount, and that is post-close. What does that mean? So liquidity is cash in the bank, marketable securities. It could be stocks and bonds, but those stocks and bonds cannot be wrapped in a 401k or IRA. Okay, so your Google stock, your Oracle, Apple, that'll work. So what we're going to ask is to see a statement from your bank that says this is how much money is here before we close. Now, once it closes, you can take that money and you can go buy a Lamborghini, whatever it is. It doesn't need to stay in the bank for you. It's just that documents that money is there. Okay. Keep in mind, liquidity is different than your down payment. We're going to ask, it's not a guideline, but many of our lenders will say, I need 5 to 10% of the equity coming in to come from the general partnership. So when we talk about liquidity, we have to be really careful because the post-close liquidity sits there, but I also need to have 10% of the whole equity that you're bringing in coming from the general partnership. So those are two different things, and you need to be aware of them. And then the last thing is experience. Experience is on the Fannie side, one deal for 2 years. Okay, not 22 months. They are really sticklers on this. So make sure whoever your sponsor is has that. On the Freddie side, here it is. 3 to 5 transactions and held for 2 years. It's a big difference. So depending on which way we're going to go, depending on which gives you more leverage, which gives you more proceeds, we're going to kind of figure out how the structure of the sponsorship team is. Okay. Now here's something that is amazing, and we haven't talked about this. The guidelines have changed in January of 2023, and a lot of people are not talking about it. And the guidelines say, oh, before I go into that, let me take you through an example. I forgot I had this. So here's the breakdown of this. $10 million deal. We're going to give you 70% loan to value. So that's a $7 million loan. Okay. This is what I'm going to need. Here's the breakdown. 7 million loan amount, 7 million net worth. 10% of the loan amount in liquidity is 700,000. Your experience, as we mentioned, and the equity breakdown. So walk with me on this. You've got 3 million, you've got 7 of the loan, 3 in the equity. I'm going to need 150 to 300 just coming from that sponsorship team. Now, here's some of the things that have happened over the past. The general partnership says, oh yeah, I'll put that 300,000 in, but I'm going to get a 2% out on my acquisition. Well, they're going to hold you to at least 5% held in that deal. Okay, so be aware of that. So the guidelines on, again, I wanted to go back on this. The guidelines changed for single family. And I told you that I had 20 single families and they just said, go away. We don't do that now. This is the guideline. Write it down. It is amazing. It is for in the Fannie side, on if you're getting a Fannie loan, 1 to 4 units that you own, 10 of the single family properties that you own them for 10 units for 2 years, you now qualify for this type of agency lending. Let me restate that. 1 to 4 unit, so that's single family, you own 10. Now that could be single family, duplex, triplex, quadruplex, okay? Those all qualify, 1 to 4s, 10 of them for 2 years. Now you qualify. You don't have to have a sponsor. You don't have to pay the 30 to 50% to that sponsor. That is huge. So if there's something that you're thinking about today I would be looking at maybe going out and, because you can easily get 10 homes. Buy 10 homes, sit on them for 2 years, and now you qualify and you can sign on loans. 5 to 50 units. It's huge. Okay. On the Freddie side, they're only looking for 2s, 3s, and 4s, duplex, tris, and quads. 10 units, 2 years, you're in. Okay. That's huge. Really amazing change for us. So here's the breakdown on how to finance using agency. We start at 1 million. Okay. These are the types of loans: 5, 7, 10, 12-year loans. Okay. This is based on the Treasury, which we saw is 484 today, or 485, plus a spread. That's how we get the rate. Now that spread is determined on several things. 1, where is it located? 2, the sponsor. 3, the age of the asset. Could also be how many units you own. I mean, there's a lot of things that go into the spread. Okay. It could also be that you want declining premium or a step down as opposed to a yield maintenance. So that rate is different and it changes every day. So this is why you use one broker, because I could quote you today and the market changes tomorrow. And when another broker gives you that price, it could have gone up or it could have gone down. Now it's not really a fair playing field. Why should I, who's done all this work, not be able to get the deal when somebody used the different rate change? Now they got it. So you got to be really careful when we talk about rates, and it is changing on a minute by minute basis. These deals, you'll see a lot of people want to see these rate charts, the rate sheets. They're only as good as when they were printed, because the minute that the rate changes, that doesn't work. So these rate sheets are gonna show you the max leverage. Well, if you're in Dallas is going to be 125 debt service coverage ratio, but you go out to, let's say, Chicago, and they're going to be at 75, 125, or 130 debt service. So there's a lot of moving parts. Okay. That's why we say, hey, let me look at the deal. Let me see where the NOI is. Let me see where the economic vacancy is, because each deal is different. The debt service will run from 120 to 155. So sometimes you want to come in and have interest only for the entire term, 10 years of interest only. Well, we're going to price that using a 55% leverage and a 155 debt service. So there's just a lot of nuances to these different loans. You can get 1 year to 10 years of this interest only. It is really amazing. It's based on 30-year amortization. There's only a 1% origination fee, whether you work with me or you work directly with the bank. But we're going to work on your behalf. The other cost involved here is this step-down approach. And what that is saying is I need some flexibility. So for flexibility to say, I know that in year 5 on a 10-year loan, I'm going to get out and it's going to cost me 3%. That is a real concrete answer to your underwriting. When you're underwriting in yield maintenance, you have no idea. It is the cheapest rate today, but it may cost you down the road. If the interest rates go up, it's going to cost you less to get out of that, because the capital markets have said, hey, I want to get out of this loan because I can deploy my capital for a higher rate. I can get paid more. But if the interest rates go down, it's going to cost you a significant amount of money to get out. So again, if you want a step down approach, it's going to cost you a little bit more in the rate. I would tell you that recently a lot of people are thinking of getting into a 5-year loan because they think interest rates are going to drop. And what we'll do is we'll buy down the rate. You might hear this. We're buying down the rate. It costs an additional 1%, and it's going to give you 15 to 30 basis points off of your rate. It's going to give you a little bit more proceeds, but it's going to drop the price a little bit. So that might be something you're interested in. These two, Fannie and Freddie, they will take only 60 days to close. So you really need to know where your money, your equity is coming from. Okay, so the different types of financing is, if it's not the Fannie and Freddie, we might look at HUD. And HUD can be available on ground up construction and on refinancing out of a bridge. This is based on a 35-year amortization. So it gives you a little bit lower monthly payment, and the debt service is a little bit lower, 125 versus 118. So a lot of people are using HUD on those bridge deals that are really struggling. That's a good option. Fannie and Freddie have also a floater, which is kind of like the bridge type agency product instead of a debt fund. So those are available. Seller finance, we've seen a little bit more of that. I would tell you that if you are having the last 500,000, you might go back to the seller and say, hey, can I keep you in the deal? We need you to help us close with this. And they keep their money in, and they become, if you want to say, seller finance that way. Pref equity is another, like we talked about on the capital stack. And then hard money and gap funding are another ways to finance these deals. Very expensive, but an option. Oops. So what do you need to provide me to get a quote? All right, so these are the 4 things. You need the T12, which is your profit and loss, and it really needs to be updated. Like right now, we're looking at August and September. If you provide me with May, that's a lot of months to September and October, and we're not providing you with the most accurate information. We call that garbage in and garbage out. So make sure your financials that you're underwriting the deals are really accurate and up to date. So T12, rent roll, your offering memorandum, if it's available, and then your underwriting. And the underwriting, we are not looking at your returns. We don't care what your returns are. A lot of people want to give us a PDF. Just send us the Excel document. It helps our underwriters be able to see how you are coming to the numbers that you have. Okay. And when do you need to reach out to me, right? Start a relationship now. Reach out now. Let's get to know each other. Do you know, like, and trust me? I want to be able to provide that for you. But you really want to do it. If it's not now, do it before you put in that LOI. And why is that? Because I may be underwriting something at 60%, and you're underwriting it thinking that you're going to get more proceeds, and therefore you put out a price that is you're overpaying. And this just happened recently. One of my clients put in an offer at 6.1, and we underwrote it at 5.2. It's a big difference. And so now the broker thinks, hey, I've got a really good buyer. Now he comes and he puts in an LOI. I come in, and my client has to change it. So the uncertainty with, that you don't have when you when you don't come to a lender can be pretty critical to your success. So make sure, come to me 48 hours before you must have that LOI in, and I'll give you exactly, based on the financials, where the proceeds are going to be. How are we underwriting them? And we underwrite with an appraiser. We meet with them, we talk to them. What are they seeing in this area? So we really get that information up front for you. So send everything to me, and as I mentioned, 48 hours. Oops. So the question is, are you ready? Everybody's talking about what Warren Buffett says. Be fearful when others are greedy. right? And be greedy when others are fearful. So are you ready? Are you ready to not be fearful and to be greedy? All right. So what can I be doing to help you? Thank you so much for obviously giving me the opportunity to share this pretty critical information for those of you who are looking for deals. What can I do to help? What other questions do you guys have?
Well, Julie Anne, thank you so much for the insight. I mean, I've learned so much in the last 60 minutes. I took
Fantastic.
notes, I took screenshots. I said, I better
Oh,
study
good.
this. Right now,
Well, excellent.
yeah, as everyone is still pitching deals out there, right? You know, capital raisers are pitching deals. What should an investor be watching out for? Like as an LP limited partner investor, right? We're being told, hey, you're getting 15 to 18% IRR. This is going to pencil out 2.2x over the next 3 to 5 years. How do we protect ourselves?
Yeah, well, it comes down to educating yourself, right? And understanding the underwriting model itself. Now, there are lots of underwriting models out there. So you want to make sure you're aligned with the model that that general partner is using. And I would be looking at the rent growth. I'd be looking at what type of loan you have that they're going to be putting on this. The fees that they're going to be being paid, right? I've seen operators taking a 5% acquisition fee. I think that's a lot of money. Now there's a lot of risk involved in these acquisitions. So I think you do need to be paid. I think operators do need to be paid because there's a lot of risk. Is 5% right? I think that's a conversation you have, right? But knowing the operator is the number one most important in today's market. What is their track record? How many deals have they closed? How much have they returned to their LPs? This is critical, and having a relationship with them. You might not want to put your $1 million in with one person. You might try. You start with a little bit with one person, with that person. Give them 100,000 and give a couple people 100,000. See how they perform. You know, it is a tough market right now. And a lot of the good operators are standing by. I just had Ken McElroy on Zoom at 8. And he is buying, he's looking. He hasn't bought much this year. To me, when I hear the people that have a lot of assets, what they're doing, they're being cautious. The deals, you need to be cautious. You need to be watching what the big people are doing, what the good operators are doing.
That's awesome. Thank you for the insight.
Mm-hmm.
Jay, do you have any questions for Julie Anne, or anyone has any questions for Julie Anne?
Well, this was terrific information. This was really good and refreshing to hear, because what happens is when you're on social media, you still see a lot of people, oh, I closed 3 deals in the last 3 months. And sometimes you would feel like you're not, working hard enough. But I think just what you just said, Ken McElroy, some of the people who have been around and have successful track record and have been through market cycles, Praxis Capital, Brian Work is another example. I mean, a lot of these people, they're just sitting on capital. They're just waiting to be greedy when others are fearful. So I think I took away a lot of really good nuggets, and I took a screenshot of one of your slides of getting back to basics. I think a lot of times that greed makes you forget those very basics, like making sure the property cash flows when you purchase. Many people have bought non-cash flowing assets. I mean, so this was really good information, Julie Anne. So really appreciate you sharing. So I do have one question about bridge lending. So we know a lot of people now are moving away from bridge lending because it's just not making sense. But some assets are not going to qualify for agency that don't meet 9490 requirement. And at that point, I think bridge is your only option. With local banks and bank funding, I think there's size limits on the loans.
There are.
But if you're
Mhm.
looking at like $20-25 million deal, I think at that point you're only looking at perhaps fixed rate bridge debt. So if you're buying an asset on fixed rate bridge today that has really good value add potential, you can see that you can take it somewhere. Where would you underwrite the refi rate set? So let's say in 16 months, 18 months, you want to refi. Because there's just, the feds just don't seem like they're stopping anytime
Yeah.
soon.
Yeah, I mean, you're
Uh,
really going to have to go into agency. And
Mhm.
I mean, I would be probably doing it at 7.5, honestly. I mean,
Okay.
I do think there's going to be a little dip in the next year. I mean, it's not considerably because it comes right back up in 2020. I don't know if you guys have seen the forward curve models. And I think these are super important and to understand and look at them. Some people, they don't like to take them into consideration, but the forward curve to me, it gives me a sense of understanding of what's happening in the market to make some very good decisions. And here's what I'll show you. I think if you haven't seen it, it's well worth jumping in and looking at, see, here it is. Okay, so this compares, this is actually the SOFR. So this is your bridge lending, okay? And we've been talking about it going up one more time this year. I've heard about 93% say it's not going to change over next week. So I think we've got another month before is it going to move up? Potentially one more time this year in December. But historically, it has held out before it goes down as we're seeing it here. This plateau has on average 8 months, 7 days of being on a plateau. This forward curve shows a very quick plateau, and then it starts to come down gently. That is great, a great thought, and maybe it is, but historically, if you look over the years, every time we've gone into the rise in interest rates, it's a crash and burn, and it's significantly quick. So I think it's better to have it drop down, step down like this, but you know, history says it doesn't. It's only happened once. It dropped down a little bit, we plateaued, and it went up a little bit and then dropped significantly. So seeing this, you know, if you're on a bridge loan and you're thinking that, oh my goodness, am I going to have to buy a rate cap in January of 2025? I've got a loan that I have on a bridge loan, and it comes 2025. You know, based on this, it's going to be 452. I'm at 550, so it's down 1%. Those rate caps are no longer going to be, you know, 1.5 million. They're going to be half. Once this starts to drop, those rate cap prices are going to be significantly impacted. And I think that's going to certainly help for those that have to buy that don't necessarily have the cash flow to buy a rate cap. But, you know, we can't get away from what is happening in the inflation, with jobs, with rent growth. All of that is impacting these deals. I just added this. This is the 10-year treasury. And as I mentioned, it is going to drop a little bit. But for those of you that are thinking, hey, I want to be on a 5-year loan instead of a 10, if you look at this forward curve in 5 years, so that's 28, it's going to be up. So do you want to do a buy down, as I mentioned, which is going to cost you 1%, and you're buying a 5-year loan, which is more expensive than a 10-year loan, and I want to step down because I want to get out in 3 years as opposed to 5, all of that costs money. And when you look at the forward curve, is there some truth to this? Now, depending on the economists that you speak to, they may say, no, that means nothing. But to me, it brings awareness. It brings some thoughts like, be intentional. Look at what we are seeing. I hope that was helpful. Just
Absolutely.
thinking about where the market is going.
Absolutely. No, this is very helpful. And I mean, it's definitely a good guideline. And I
Yeah.
think if you're doing these projections as an investor, as a smart investor, that's probably the best you can do, because by the end of the day, everything is a speculation. Your
Correct.
exit cap rates, it's more of an educated guess. Sure, you can look at CoStar and reliable data sources, but you really don't know where the exit cap is going to be at.
We don't even
and
know where the cap rates are because there's
Yeah.
just not enough deals that are going on. And that's, that's also, it's kind of like a poof. Oh, well, what will the market bear is really what it comes down to.
Right. Yeah, because 1 year ago, when we were looking at when the rates had just started going up, if we look at the forward-looking SOFR curve, they were supposed to already come back down end of this year, but they haven't. So now, obviously, the forward-looking SOFR curve has changed.
Yep.
There's really no way to predict.
Yeah.
This is great information. And there was there's a question from Siraj. Feel free to unmute yourself, Siraj. Go ahead.
Hey, you guys, I asked my questions quick. My daughter's walked in the background. So this is unrelated to lending, but one of the things you mentioned, Julie Anne, was talking about secondary and tertiary markets. With what we're saying that, there's more distressed real estate coming, why even go down the route of buying in a secondary and tertiary market if you can just stay in the primary markets and just wait for the right deals to come, especially if we're predicting that they could be here within the next year-ish?
I think there's so many people that are sitting on the sidelines. Only one group gets that deal, right? So if you can be successful in a smaller market, that might be the way to go. Maybe you can be, buying 2 or 3 in those smaller markets, then getting a possible one in Dallas. Now, the cost to run it is going to be a little more expensive, but historically, the ups and downs of those tertiary markets are significantly less than what you get in Dallas or a large market. So again, I think it's going to come down to where your comfort level is. But for me, it's kind of like one of those things I talked about, those single family homes. I'd rather go buy 10 single families now, and so that I can go be my own sponsor, than to have somebody else, taking money out of my pocket. Again, that's who I am. I'm wearing the cape. I'm going to do this myself. I'm going to take action. Am I going to wait till a deal comes in that best market, or am I going to look for opportunities? And I think, Neil Bawa has said at the Old Capital Conference and other conferences, he has said the downtown markets, 10 miles from those, are going to be significantly impacted by the city center, by the jobs that are going to be lost and that are not coming to those office buildings. So maybe it's not necessarily Dallas, but maybe it's Carrollton, maybe it's Arlington, maybe it's Sherman. That's a little bit further touch than Dallas. So, Sonny.
Hi there. Quick question. Yeah, I enjoyed your presentation. Thank you. This is the first time I'm coming across a forward curve. So on the forward curve, I was a little bit disappointed with the forward projection, which is a 10-year treasury supposed to be at higher than what it is now, 3 or 4 years from now?
Oh, yeah, and continue up.
Continue up. I find that hard to believe that would happen. I don't know. I mean, yeah, thank you. This is the one. For this, the economy, for this to happen, the economy would have to continue to grow at a fast pace. Unemployment would have to remain at a lower pace, at a lower number. So a lot of factors have to come together for this to happen, right?
Well, and you have to remember, this is just the 10-year treasury. There's also a spread and the spread is wide right now. It's 250, 280, up to 300. So that's going to come down. The cost of capital is going to come down for that. So while, 5 years, I've got a 10-year treasury at 523, the spread may be 1, right? Because there's so much, positive environment. We've got jobs, blah, blah, blah. We don't have, there's more opportunities for the capital markets to make money. That's why, yeah. So what we just need to be really aware of is the 10-year treasury. If it moves and life is progressing and deals are getting done, the capital markets is going to start to, they're going to shrink those spreads.
Oh, so in which case the 30-year mortgage rates are likely to be lower, right? If the spreads are lower.
So you're talking about home?
Yeah, right.
Yeah. We don't work on the same, we're not on the same as the single family, so I can't speak to that. Right now they're at 8.
Okay.
I do know that
yeah.
for a fact. So, yeah.
Because you mentioned something about buying 10 single families. I'm in the single family market,
Yeah.
and right now there's a lot of deals to be made in the single family industry because everybody's bending over backwards to woo the buyers. There's never been a better time to buy a single family buyer than right now.
I agree with you on that.
So that's one thing. And secondly, my second thought was about all these foreclosures that are expected to happen in the multifamily market. What are and there's a lot of money waiting for a lot of smart investors. The big guys are waiting to swoop in and just have them.
Yeah.
What chances that, is there any, does the Compound Group or any other groups have contacts with banks where the banks make those deals available to certain companies? So how does it work? I wasn't here for the S&L crisis, and I don't know how that happened.
Yeah.
I've read a lot about it, but you were in the industry at the time. So how
I
does
was, here's the thing. It's not going to be publicized. It's going to be, it's going to go back to, let's say, the broker who sold it. They're going to try and find buyers for that asset. I have gone back on a deal that it didn't even make sense with what the loan amount was. And I went to the lender and I said, hey, it's 6.3 is what the loan amount is. It's not valued except for like 5.7. Will you take a loss? I said, no, we're not taking losses. So is that the bank saying, yeah, we're not gonna let this go out? Or is that we're gonna work with people? I know I just heard that, in fact, this deal, I think it's this deal. Yeah, it was this deal. It was coming, the maturity date on that bridge loan was the 22nd of October, and it was up for sale, didn't sell. And I went and I asked, hey, what's happening? He said, the bank is working with them. So these lenders do not want to own these assets. Now, if it's really, really, really distressed, then they're going to take it back and they're going to have, an asset manager who will run it and do a good job until, it can be released to the market, productively.
So my thinking on that is the crisis that everybody's expecting to happen, is it really going to be that big of a crisis? Or is this just something that everybody's hoping that there will be a crisis?
I think it depends on who you talk to.
Okay.
Depends on the operator, depends on the sponsors.
Yeah. So I just got a letter that came out and it said, because, a lot of people are in distress, right? A lot of these deals that went bridge are in distress and they need to figure out some way to either sell them, refinance them, capital call. And if, as an investor, if I've got some money on the line. If someone comes to me and says, yeah, I need, 1.5 million to keep this deal going. If it's not a strong reason why I should put my money into it, I'm walking away. I'm
Yeah.
walking away from that capital call. So you have to make sure that the reason you're asking for it has a good forward thinking response down the road that we can, hey, this is just going to get us through the next 12 months. We're getting into agency. We're going to start making money in a year. I need it 1.5. If somebody were to come to me and say that, I can get my arms around that. But if it's just to extend it for 1 year, what happens after a year? Am I going to have to put more money into it? No. So you really have to dig in if you're an investor on these deals. Again, going back to that, who's the operator? What is their experience? Are they, do they have a proven track record? Are they working with a property manager that is skilled?
Mhm.
I mean, that we are paying our property managers so little money when it comes, when we, on the whole scheme of things, right? We don't pay our property managers enough for the fiduciary responsibility that they have to our investors. And they don't have a fiduciary responsibility. We do, but we give them all of the power. We got to incentivize these guys.
Yeah, absolutely. I agree with that 100%.
Mhm.
Yeah.
Well, Julie Anne, thank you so much for tonight.
You're
And for
welcome.
those of you who have not been on Zoom at 8, I got to tell you, Julie Anne, that is the best organized group call that I know.
Well, I
I
appreciate that.
yeah, I not only do I attend, but when I am on treating patients, I usually leave it on. And then my
Oh.
assistants will walk into the room. They're like, what are you listening to? Right.
Yeah.
And your Old Capital Conference. I haven't been yet, but from
Yeah.
what I have heard, it is one of the most insightful, no
Yeah.
fluff conferences.
That's
A lot of conferences, people go out and they try to sell their programs and
Yeah.
whatnot. But your program, your conference that people go to, it's like, wow, I got so much out of it. It's unreal. So
It's a fire hose of information. Yeah.
thank you so much for
You're
coming
absolutely
on.
welcome.
And I hope everyone appreciates that. You spent your Friday night with us. We really appreciate you.
You are welcome. It's a pleasure and a treat to spend time with you guys. So thank you so much.
Thank you so
Thank
much.
you.
Really
You're welcome,
appreciate
Jay.
it.
Really appreciate
Thank
it. Thank you.
Thank you guys for
Thank you.
hosting.
Sure thing.
Thank you guys.
Bye.
Have a great night.